Welcome, everybody. This is Wendy Barlin with About Profit. And today we're honored to have Angela Bassard with us. She's the CEO of Conquer Your Credit with several years, just a few, of experience in the credit market. And as you know, credit affects our lives in so many ways. Not only when you buy real estate or try and get a loan, but even a car. Today, people are using your credit for so many things. And I think for many of us, me included, it's often a big black hole that we don't really know much about. So welcome, Angela. Share with us your wonderful knowledge, and then I'm sure that everybody on the call is going to want to jump in with questions at some point. So I'm going to hand the microphone and the screen over to you, so you can go ahead and share. Down at the bottom, you see the share screen.
Okay, yes, I definitely will. First and foremost, Wendy, thank you so much for the opportunity to speak to your clients and your friends. I consider it an honor and a privilege to be here today and to share my wisdom that I have gained over the last 30 years. Yes, I was doing this when I was a baby, but I love what I do simply because I get to help people, and that is my life's mission. I am living my dream when I am helping people, and this is one of those things that I think is sometimes a mystery to people, and what I want to do is demystify what is a mystery. So today I'm going to be going over some top level things that you need to know about credit. Now I am going to be sharing my screen, so if you ask questions in the chat, I won't be able to see them. So here we go. All right. So I always like to start with what my why is. And these are my jewels, I will call them. These are my children. And every morning when I get up, I am so grateful to God for these three jewels. And they are my why. I have pictures of them everywhere. I have pictures in my phone. And anytime I do anything, it's about them. And so you'll see on the top right-hand corner is my son that just graduated from LA Film School. That's Jordan. And he is very passionate. We are actually working on a documentary together, and that's fun. But also he has dreams and aspirations to do film and photography, and he's very, very busy. So I'm very proud of him. The next guy in the middle, my Moni in the middle, is Justin, my basketball player who is going to be playing in Australia. He is my 6'7", just really, really passionate guy who is a power forward. Super excited for what life has for him. He also is majoring in economics. So his goal is to help people with their money. So he's following in his mama's footsteps, and I love it. And then I went and got crazy and had another baby when I was 42. And that's the guy over to the left-hand side there you'll see is my 9-year-old. And I gotta tell you, he helps me keep my zest for life because he is literally 8 children in one. so he's a lot of fun. So, today what we're going to be talking about, just so you guys know, is why is your credit history so important? Well, first of all, one of the things that I always tell people is that your credit is an investment tool to build wealth. And what we're finding in this new world of technology and this new world that is going into a digital world where we're not going to be touching money anymore, everything is based on your FICO score. And so it's really important to know and understand how to use this so that it can be that wealth building tool for you now or in the future. The other thing that it lends for us is that hassle-free lending. It's nobody really, well, I don't want to say nobody because I've been involved in situations where it's not been like this, but most people, when they go to buy a house, don't say, you know what, I'm going to write a check for $1 million today and buy that house. First of all, I'm sure that the accountants out there in the world would say that's not a really good idea. And number one, why don't we leverage off of the bank's money? And listen, at the end of the day, right now, money is so inexpensive. So the hassle-free lending is a kiss on the cheek. It's important to start a corporate profile for those of you that are out there in the business world doing business. You have an LLC, a C Corp, an S Corp. A lot of people, unfortunately, build their businesses on their own back. They build their businesses on their own credit back, and the debt sits in their personal name. And that is not a good practice in business. So what I teach people is to separate their credit assets from a business perspective and a consumer or a personal perspective. It's crucial actually to the sale of a business too. So really, really important. So today's discussion, we're going to be talking about understanding that thing that everybody calls my FICO score or my credit score, the credit agencies or the credit bureaus, knowing and understanding them. And I always say to monitor or not. And let me tell you, if you're not, then you're making a huge mistake. And we'll talk about that. And the reason for that is that identity theft right here, what you need to know, identity theft is the #1 crime in America. Collections and legal credit judgments, what you need to know about that, the different things that you need to know about credit cards, and helping your clients with their kids now. So one of the things that I always say is that the greatest gift that we can give the youth or our children is the gift of financial literacy. I think it is so vastly important that we do that and that we take the time. If you have not taught your children now and they're older, so what? Teach them now. Teach them what you know. If you have grandchildren, teach them the value of money, the value of credit. Go with them to the bank and open up a savings account, but teach them now because the world is rapidly changing. And the one thing that I think is so important for everyone to understand is finances and how to work with money. So here we have it, the credit score factors equals FICO. And these are the different things that actually go into a credit score, as you can see in the FICO, what I call pie chart. So you have debt ratio, length of credit history, new credit, types of credit, payment history, utilization factor, address history, which a lot of people don't really understand is important. Now, the thing is that unfortunately, the way that the algorithms of FICO work, which is a mathematical equation, is based on your human behavioral patterns. So unfortunately, they pick up a lot of these patterns based off of how we spend, based off of how long we've had credit, based off of how we make our payments, based on how much we use our credit. So you'll see over here to the left-hand side, 30 and 35% is taking up the biggest piece of your credit score, okay? And what you'll see is that it says amount of debt and payment history. So those are the biggest pieces or the biggest assets of your credit and how your credit score lands in the way that it lands. So let's take that 30% that's at the top there, amount of debt. I have seen so many people that have had perfect credit, but unfortunately their debt to credit ratio is super high. Now, the debt to credit ratio that we're talking about really is your revolving credit cards. Okay, it's not your homes and your cars or even your American Express, which is your sign and travel. American Express sign and travel is really an installment credit card. Believe it or not, the credit system is really looking at your revolving credit cards, your Visa, MasterCard, Discover, more than they're looking at your installment debt or the way that you utilize it. So that 30% is really focused on your revolving credit and how you use that and how much debt you actually have. So let's say that you have 3 credit cards and the high credit limit that you can utilize on that is $10,000 and you've used $9,500. Chances are your credit score can be 100 points lower when you go to pull your credit history simply because your credit to debt ratio is too high. And the reason that they make that a flag is that potential lenders or creditors want to know if you're in debt, so to speak. Now, a lot of people just utilize their credit cards a lot because they haven't done what I said in the beginning. They're a business owner and they use their credit cards for everything. And because they have not separated their business credit assets from their personal credit assets, their FICO score is lower because of how they're running their business. So you can see how this is ultra important for you to make sure that you separate the two. The next one on the left-hand side here, the 35% payment history, that is ultra important too. If you make a late payment, okay, unfortunately, that's going to affect your credit history. If you have a charge-off on an account, meaning that you did not pay a credit card back, okay, and the debtor has written it off as a loss, unfortunately, that can severely affect your credit history. Also, the payment history looks at your utilization factor. Now, what do I mean by utilization? All banks and financial institutions are in the business to do one thing. And what is that? To make money. And the more you use your credit card, the better it is for them. Now, we can play the game to win, and we can be smart about how we do it. The one thing about utilization factor is that as long as you use your credit card once every 90 days, you are pushing that utilization button and you're getting credit for it. But if you don't use your credit card at least once every 90 days, it actually becomes a risk for you. So I talk to a lot of clients, and I know some of you guys will have questions about this. I talk to a lot of clients that have so many credit cards, and they're like, you know what, Angela, I don't know what to do because I have so many credit cards, and a lot of them, I just keep them for a rainy day or for emergencies. And what the banks and financial institutions are doing is saying, we don't want to have that risk anymore. So if a client that we have is not actually utilizing their credit card, we'll do one of two things. We'll either cut their limit or we will cancel the credit card. So utilization factor actually became very important in the past 2 years. And because of COVID-19, unfortunately, a lot of banks and financial institutions are on red alert. So if you have credit cards that you have not used in a long time, I would just tell you, go out and make a small purchase. And when the bill comes in, you can pay it off if you want to. But another tip of utilization is actually revolving interest at least once or twice a year. Again, we talked about that the banks and the financial institutions are in the business of wanting to make money. And the best way that they can do that is by charging you interest. But if you are a customer that typically uses your credit card and pays it off at the end of the month, believe it or not, you're actually a risk to the bank instead of a reward. So really important, at least one time per year, what you want to do is practice the 80-20 rule. When your credit card bill comes in, you pay 80% of the bill, leave 20% to revolve, and pay interest the following month. And by doing this, believe it or not, friends, your FICO score will soar and always be anywhere between 30 to as much as 50 points higher because you're using this particular utilization factor. Do I have any questions so far?
No.
Nope.
Well, I mean, I pay my credit card off all the time. I never run it where I have to pay interest. I didn't realize that, I was doing myself harm.
Yeah, I mean, it's a crazy thing to think that it's harmful, but I don't want to say that it's harmful. It's just that you're not getting the mileage out of your credit score that you could be getting. So let's just take a hypothetical situation in talking about this. Let's say that you're an investor and you want to use your credit, and because you haven't used that rule, your credit score is not as high as it can be to get the best interest rate on the next investment that you're going to do. if you just follow that rule of thumb, which is very actually easy, what I do is I'm very controlled, obviously, because I do this for a living, but I'm very controlled with what it is that I do. So the month that I'm going to actually revolve some interest, what I will do is I'll only spend $100. So when the bill comes in and I'm paying that 80%, I'm paying the $80, I'm leaving $20 to revolve and pay interest the following month. And guess how much I'm paying? Maybe $2.75. And I do that one time a year, and I always have a higher FICO yield because of that. Okay, so the next thing that I want to talk about for those of you that are in the business of wanting to actually buy real estate or do any types of transactions, the one thing that you have to know and understand with the credit score is that if you close a credit card, if you get a new credit card, or let's say you close a lease on a car, for the first 60 to 90 days, it will affect your credit history or your score from a negative aspect, but this is just temporary, okay? And the reason for that is that the credit score is always looking for balance. So it's kind of like Jenga, the game Jenga, where you put the blocks on top of one another, and when you pull something out, things fall over. So that's the same way that the credit scoring system works. So if you're in the middle of a purchase, or any of you people out there that are real estate agents, always tell your clients, make sure that you don't actually apply for new credit or close any credit during the transaction, because if you do so, it can negatively impact your credit history. So
I did that. Can you believe it? I'm an accountant and I did that. I should know better, but I was halfway through a purchase. It didn't even occur to me, it takes forever. And I leased a car, and my mortgage person called me and said, did you just lease a car? I'm like, yeah, I need a new car. My lease was up. I turned it in. He's like, oh, God. Then you have to explain yourself, right? And now they've got to redo all your debt ratios. So yeah, I learned the hard way about that. Never again.
Yeah, it's unfortunate the way that the system works, and I'm hoping that my documentary, when it comes out, that it will expose these hacks that are not helpful to the consumer. But yes, unfortunately that does happen. So moving right along and talking about the different types of credit, okay? So you have credit cards, department store cards. Now, here's the thing. A lot of people think that department store cards are the same thing as having a credit card. Now, they can be. And the way that they can be is if, let's say, you have a Macy's American Express card, okay? That is going to be a department store card / real credit card, okay? Now, back in the day, the department store cards were specifically for that. You couldn't take your JCPenney's card and go shop at Nordstrom's. Okay. And so basically what happened is the department stores said, hey, you know what? We want to get in the action of, basically retaining purchase money from our clients. So they partnered with different banks, and a lot of, you'll see Nordstrom's, actually, I think they just changed to Citi. Costco, if you have a Costco card, their Citi, like I said just now, Macy's is American Express, but you will see that all of the retail organizations now are actually partnering with a bank, so that you can go out and use that credit card and make purchases outside of that particular store. You have bank loans and cards. So you have, like I said down here, HELOCs, home equity lines of credit. Now, a lot of people don't know and understand that when you have a HELOC, it is considered a revolving line of credit. So if you only have 2 credit cards, and let's say they're, $10,000 a piece, you got $20,000, and you have a home equity line of credit that's $150,000, and you've done some improvements to your home, and you've used all $150,000 of your HELOC, unfortunately, that slide that we just looked at prior, your debt to credit ratio is going to be super high, because you have nothing to balance out that home equity line of credit with your other credit cards or any other credit that you may have. So you have to be careful with that. Also, gas cards. Now, I always tell people I am not a big fan of gas cards. First and foremost, they are extremely high interest rates, and they're really good for nothing. What I tell business owners all of the time is that what you need to do in order to budget well on the credit cards that you're using and making sure that you can track transactions is take one credit card that you have that's, you know, a lower interest rate and use that particular card to get your gas. All right. So I'm not, I'm not saying get rid of all your gas cards. I'm just saying that you got to look at the interest rates and see if it's worth keeping those. Now, those are your revolving types of credit. The other type of credit is installment credit or installment debt. And that's going to be your mortgage, your automobiles, your student loan line of credit through the bank, like an equity line of credit. Now, the reason why they are so vastly different is that installment credit is very simple. You have a contract, you're making a payment, and it has a maturity date. Revolving credit, on the other hand, doesn't have a maturity date. So it continues to revolve until the bank closes it or you close it. And this is the best way that a bank or a financial institution can have an understanding of how you leverage your cash position. So this is why I told you in the slides before that revolving credit is the master of mastering your FICO score. If you have at least two or three revolving credit cards and you use them properly, you will always have a really good credit score. Now, talking about the credit agencies, I always like to disclose this. On the bottom right-hand corner, you're going to see that there's a company called Innovis Data Solutions. Now, they are the fourth credit bureau that is actually going to be coming into the picture. Unfortunately, already we have three of the crazies that we have to deal with, right? Which are Experian, TransUnion, and CBI Equifax. Now we're going to have a fourth one. So what's going to happen is that we're going to go from having the middle credit score to having the average credit score. And they should be actually in the business, they said, in 2022. So it is coming up. Not too fast, but it is coming up, and I always want to make people aware. Now, they have been trying to break into the industry for about the last 8 years. So you can see them when you go to an ATM machine, you will see their emblem, and you will see that they have been a for-profit business for a very, very long time and ensuring money. So they do understand the credit system. They call themselves the People's Bureau. And I'll believe it when I see it. But the thing that we have to remember is that all of these companies are for-profit companies. They are separate entities. And what do they profit off of?
Yeah.
Me and you and our information. Okay, so we're going to talk about that in a later slide, but this is why I said that identity theft is the #1 crime in America, because the credit agencies and what they do is they collect information, they collect data, and what they're collecting is data on you and me and what we do with our credit, where we live, how we shop. Have any of you ever had the little rewards cards when you went to Ralph's or you went to Petco or any of these companies, and you go and you pay at the cash register and they say, do you have your rewards card with you today? And you say, yes, I do. Well, why do you think they want to see that rewards card? Because they want to track you and they want to track what you're purchasing so that they can then go and tell their customer how to market to you and market to the public the right way. And they get all of these algorithms and information from these four entities that we're talking about right now at the bottom. Okay. Now, each agency reports and calculates things different. And the reason for that is that banks and financial institutions many years ago used to report with all three credit agencies. But what we have to understand is that there's a cost for doing business. So each and every one of these companies has to pay Experian, TransUnion, and Equifax to report their data and information. So they went back and sat with their boards and said, you know what? We really don't need to pay all three of these agencies. Let's just choose one or two of the agencies and report our data with them. And this is why, friends, we have the middle FICO score, because not every agency has a relationship with the bank that you do business with the credit cards that you use on a daily basis. Now, some of them do report to all three, but most of the time, in probably the last, I would say 10 years, a lot of banks and financial institutions do not report to all three credit agencies. And again, this is why we have the middle score. The other thing to know and understand is that each bureau has their own scoring system. Now, I put Accept and Novus. They do have their own scoring system, but it's not public yet. Okay. Of course, I've been doing research on these guys for many years, so I do know the algorithms that they're going to be using. But the thing to know and understand and remember is that each agency, just so you know, uses their own algorithms to comprise what your score is going to be. Now, Experian uses the originator, which is FICO. FICO is the originator of this mathematical equation that we call a credit score. And then TransUnion uses a different system, as well as Equifax. And they have their own names for them. Equifax uses Beacon, and TransUnion uses a system called Empirica. Now, you guys will never see these names ever, so I'm giving you some information that you'll never use, but those are the names of their particular systems. The main hub or the main system is FICO. And the mathematical algorithm equation that they created is now being used for so many different things. It's being used in the medical industry. They're using this algorithm that has spread so wide and so far for many, many different things. But these are the agencies and what you need to know. Now, talking about the three scoring models, the thing that I always like to impress upon everybody that I talk to is that you have to understand that you have 9 credit scores, okay? 9 of them. Now, why do you have 9 credit scores? Because there are 3 different types of scoring systems. You have consumer, financial, and auto score systems. Now, a lot of people, what they do is they say, oh, I looked online and my credit score is 760. Okay. The first thing that I always ask people is, where did you get that information? Because if you got it from Credit Karma or you got it from an online system, that is called a consumer credit score. Unfortunately, friends, that score is good for nothing. No one actually uses that credit score. It's really just something that you can have to see and understand where you stand, okay? But the financial credit scoring system that the banks and financial institutions use is vastly different from the consumer scoring system. The consumer scoring system is looking at your credit as a whole. When you first got a credit card until now, it's looking at how many places you've moved. It's looking at how many inquiries you have. It's really a much more fair assessment of who you are as a borrower. But unfortunately, the banks and the financial institutions have chosen what they want to show up in their scoring system. And so there are over 150 different factors that go into this credit scoring system, and the financial scores are only looking at 80 of those 150 different factors. So it's the very reason why you can look online and say, oh, my credit score is 760. And when you go to the bank, they say, I'm sorry, it's not. Your credit score is 720 or 700. So always remember that when you're looking at your score online, it's going to be different when a bank pulls it. Now, the third one is the auto model score. And those are loosely based on the amount of automobiles that you've purchased over the life of your credit. And this is the very reason why they have the first time buyers program. And unfortunately, when you have never purchased a car before and you go to purchase one, the interest rate can be vastly high because you don't have any history, hence you don't have an auto score. And this is very important to know and understand, and also for those of you that have clients, for you to tell your clients about this. Moving right along, we have what I said earlier, your credit equals your habits. And I want to just make sure to point out one portion of this slide, and that is, who am I? How many places have I lived in my entire life? How many ways do I spell my name, and do I go by any other aliases? What companies have I applied for credit? How many employers have I had over the span of my professional life? And do I own my own business? Now, the reason I said that this is important is because this also goes into your algorithm. I see a lot of clients that come all the time, and they have so many different addresses on their credit report. And unfortunately, what is really, really important is that you only have the last 5 years of residence showing on your credit report, okay? You don't need to have the last 50 years of where you've been living. And if it's there, then you can simply ask the credit agency to remove it. And the reason why we want to make sure that we do that is because if you have so many addresses on your credit report, it can actually be looked at as a risk. Now, the other thing is, how many ways do I spell my name? That can also be a risk assessor for a new creditor that you're working with. So make sure when you're looking at your credit report that they're spelling your name and information the correct way. And also, if you have any junior, senior, 2, 3, whatever it is, you have to make sure and separate yourself from those particular people that are in your family that you share the same name with. So it's very important. Like, my husband is a junior. And a long time ago, he had all of his dad's information on his credit report. And the biggest reason that that happened was because he wasn't applying for credit in his real name, which is his first name, his middle name, his last name, but including junior, because that is his name. So it's very important to make sure that our names are being spelled right. Now, what companies have I applied for credit? A lot of people are always very concerned with inquiries, and they think that, oh my gosh, it's the end of the world, I inquired on my credit. Well, I couldn't tell you that that is further from the truth, and it is an old wives' tale. You can check your credit whenever you want to, okay? The only inquiries that really can hurt you, so to speak, they don't hurt your credit score, but an underwriter can ask you why you have so many, or when you apply for goods and services, and when you're filling out an application and they're doing a hard inquiry. But when you're checking your credit online and you're doing it from a consumer aspect, you can pull it every hour, every minute, and it will not affect you in the least. The next one is, how many employers have I had over the span of my professional life? I always tell people that they should make sure and keep this at a lull as well. Make it only who you're working for now. And if you own your own business, put on your credit report the name of the business and that you work for that business. Very, very important that you don't say that I'm a sole proprietor or that I own my own business and you don't put the name of the business. Now, monitoring your credit is so, so important. I can't tell you how many times I am speaking at big events and I ask the whole room, how many of you are monitoring your credit report? Because you know what? We insure our cars, we insure our health, we insure, but we don't insure the one asset that can come to bite us in the booty if we are not monitoring our credit. So it's very, very important that you do this, and you can do it for free, guys. So we have no excuses. Make sure that you sign up for one of these free services and you monitor your credit. It can save your booty, like I just said. It can really, really save you. And it's so, so important. And unfortunately, it can get a little addicting because you're wanting to see your score and you're wanting to see your accounts and you're wanting to see how things are being reported. But if one thing I can say you can be addicted to, that's good. Making sure that you're addicted to your credit being in a good and an accountable position. Now, these are the top sites that I would say you can monitor with if you want to have a paid site: Experian, LifeLock, Privacy Guard, and high-level monitoring through my company as well. Now, high-level monitoring means that we do all the work for you. We get all of the alerts. We handle anything that comes up. We just do it all. But it's very high level and it's expensive. And so we do it for a lot of high profile clients. But the thing is, and that I want to impress upon you today, is that if you don't monitor your credit, you will find yourself in a very precarious situation. And I don't want you, friends, to land there. Now, this is how identity theft really happens, okay? Now, what we know is that who on this call doesn't use the internet? Well, I'm not going to look for the hands up because every single person, even my 2-year-old little niece, uses the internet. So there is not one person on this call that does not use the internet. So your information can be stolen from the internet, okay? Very, very easy. Because I am very technologically savvy, I can go online and I can find anybody. I can find where they live. I can find their social security number. I can find their date of birth, where they've traveled in the last year. I am very technologically savvy. And let me tell you, I'm not technologically savvy. When I'm talking about tech savvy people out there, this is why, friends, monitoring your credit is one of the top things that you need to do, because you can protect your identity this way. Loss of wallet or personal belongings, applications that you're filling out online, government institutions. I bet you didn't know that the Social Security Administration was hacked. Last year alone, there were over 982 breaches. Did you hear me? 982 Fortune 500 companies that were breached. That means that information is accessible all over the place. And I can't tell you how many times I've heard family members have used my information, and mail fraud, which is another way. We're seeing it now all the time. Unfortunately, in Los Angeles, we have a huge homeless population, and a lot of them are stealing mail. It is very, very important that you know and understand that identity theft can happen at any time, and you need to take the steps to protect yourself. Am I trying to scare you? Absolutely. If I can scare you into taking action, then that's what you need to do. Now, if you have been a victim of a breach, here are the different things that you need to do to protect yourself. Make sure that all 3 agencies are alerted with a fraud alert. Now, it's very important that when you file a fraud alert, that you put your phone number with the fraud alert, because the next time someone pulls your credit report, if they see the fraud alert there, they will not grant you credit unless your phone number is there and you can identify that phone number. And in some cases, the creditor may call you on your phone to make sure that it is you that is actually filling out this application. Credit freezes, okay? Now, a credit freeze can be a real pain in the tuchus, but it can also save you. Why is that? Because freezing your credit cuts off the outside world from being able to pull your credit whenever they want to. Never forget, I was going to buy a car, and on my license plate, it says the Credit Queen. That's my license plate. It says Credit Queen. So I was talking to the finance manager, and he's like, geez, you know, don't you do something in credit? And I said, yeah. And I told him what I do. And he's like, well, you don't have any. And I said, oh, yes, I do. Just give me a minute. Got on my phone, unlocked my credit. And of course, he pulled it in. It was over 800. But the point is, you can freeze your credit and unfreeze your credit anytime you want. Okay, but this is very, very serious that you take this action if you have been a victim of a breach. Okay, also, if you've been a victim of identity theft or anything like that, you need to have a police report and a fraud affidavit filled out. And all of those things can be gotten off of the Federal Trade Commission's website, and it's very, very easy to do. So let's talk about really quickly, how am I on time, by the way?
You got 20 minutes, I think.
Okay.
Yeah, we're just at 12:40, and we want to leave at least 5 or 10 minutes for questions, Angela, if you don't mind.
Okay, no problem. So moving right along, what can hurt my credit? Well, I know that this is shocking and funny, but a dollar collection. Now, believe it or not, we see it all of the time where people have a $5 collection. Yeah, it can hurt your credit, okay? So when you get those notices in the mail, do not just stick them in the trash. You have to pay attention to everything that you receive in the mail. Going over your credit card limit by $1. If you max out your credit card, it can drop your FICO score 100 points. Having too much credit. Never forget this story. My sister went to her house. She's married to a multimillionaire. I look in the corner and I see this stack of bills this high. And I says, what is that? She says, oh, that's all my credit card bills. And I said, what? What do you mean that's all your credit card bills? She had 52 credit cards. And the reason that she had these because she walked into the store and they said, oh, we'll give you 10% off if you get our credit card. I'm like, honey, you don't need 10% off. Okay, so what did we do? We went and closed all of those credit cards. She has 3 now with large limits and she can shop till she drops. Having too much credit can be a real pain in the tuchus and it can cause a lot of confusion. So make sure that you just have enough credit to sustain your lifestyle and to sustain what you need to do. Length of credit. Okay, if you have a short credit history or what we call in the business a young credit history because you had a bankruptcy and you're starting over, or you're young and no one told you to get a credit card when you were in college. All of these different things can definitely hurt your credit history. The other part of that is closing credit cards and opening new ones. You can't close a credit card that you've had for 10 years and open a new one because they're giving you a better interest rate instead of asking your old credit card company, hey, this credit card company is offering me this interest rate. I'm going to leave if you can't give me this interest rate. Most of the time, 9 times out of 10, that bank will give you the interest rate if you've been a good customer. So not enough credit or no credit. Obviously, that can hurt you. If you don't have any credit, you're not going to have a credit score. Late payments within the past 24 months, very specifically, and even right now, can severely hurt your credit history. These are the kinds of things that we at Conquer Credit can help you with. And these are the point drops that you will realize if you have any of these types of derogatories. And we're going to go over this page really quickly because I don't think it really applies. The collections do and don'ts. Does anyone actually want me to go over this or should we fly by this one?
I'm okay.
Well, I'm just going to tell you really quickly, never, ever, ever pay a collection agency without a commitment that they're going to delete the negative status that's on your credit report, okay? And the reason for that is that if you have a collection that's 5 years old on your credit report and you pay it today, what's going to happen is that 5-year-old debt is now going to be concurrent debt right now, and it's going to negatively hurt your credit history and devastate a transaction and specifically your credit score. There are a lot of different practices that you need to know about when you're dealing with collection agencies. And what you'll see at the end of this is that I actually do a podcast and I talk about all of this information in my podcast about the do's and don'ts, what you need to know about medical bills. I'm actually, tomorrow is my podcast and I'm going over what you need to know about looking at your statements. If you've had a hospital bill, if you've had a loved one pass away, all these different things that you need to know about collections and how to use them. To settle or not settle, this is about, debts. A lot of people think that, oh, you know what? I owe $20,000 to my credit card and I don't want to pay them all. I've come into some money and I'd like to pay them less. Well, the first thing you need to know and understand is if that is a good credit card that you've had for a long time and you decide you want to settle that debt, it is going to devastate your credit history, okay? Because what's going to happen is that they're going to report it as a settled in full debt on your credit report, and your credit score will actually take a dive. So this settling is really only for people that unfortunately can't file a bankruptcy because they have too many assets and they have not paid their credit cards or their debts in more than 6 months. okay? There are always tax consequences to any settlement that you do. Most companies are going to send you a 1099-C form that is looked at as income. So a lot of people think like, oh, I'm saving so much money. Well, yes, you can be saving money. It's not that you're not, but you do have to understand, unless you're insolvent, you are going to owe some taxes. Okay, so really, really important to know and understand. Public records, just so you know, no longer show on credit reports with respect to tax liens. So tax liens do not show on credit reports, but judgments, notice of default, and bankruptcies actually do show up still on credit reports. Only tax liens don't show up. So these are the kinds of things that you can see on credit reports, and they do affect you. However, with bankruptcies, they don't affect you as much as the accounts that are included in the bankruptcy, like your creditors that you had that were charged off during the bankruptcy. Now, the last thing I want to talk about is judgments, because I'm dealing with a lot of clients recently that have been served. And a lot of the times what I hear is, you know what, I'm just not going to answer the door so they can't serve me. Well, here's the thing. It doesn't matter, because the laws changed several years ago. They don't have to serve you. You don't have to sign anything. They can still file the judgment. Okay. So don't avoid it. I would say sign for it and get the documentation and the paperwork and see what's going on, to see if you have a case where you can basically dispute things, and or you can negotiate a settlement with that particular debtor before they actually file the judgment. Okay, most of the time they're giving you 30 or 60 days before they file. But because so many people are like, oh, I don't want to sign for it because I don't want them to know I know what's going on, they miss the opportunity to actually take care of it. So a judgment that someone's suing you for $20,000 may be able to be settled, and you can get rid of attorney's fees and court costs and all the rest of the mishmagosh, and maybe pay them $12,000. Okay, so all of these things can be negotiated. It's about looking at the documentation, having an understanding of the new laws that are out there, and being able to protect and optimize your future. So judgments, you know, it's not great to have a judgment, but at the end of the day, it happens. But I just would like to say, don't stick your head in the sand. Look at it head on and take care of it. So establishing credit, now that's the biggest thing that I talk to a lot of young adults about. I have a program, it's called Your Credit Swag, and I talk to young adults about their credit and finances and why it's really important. I mean, listen, guys, these kids would rather go and sit in a dentist's chair and have their tooth extracted than to go into the bank. They hate it. They do everything on their phone, but they don't understand the system that was created that is so wonderful, because we live in the US, and you know what they do? They say, you know what? We're going to trust you, Angela. We really like you because you have a good credit score. If you want to go ahead and buy that car, you're going to do it on credit. But you have to build your credit and establish credit, because it's like a relationship. And then when you go to the new vendor, they're able to look at all of your relationships that you've had and how you've treated them, and that's how they give you credit. So it's really important, like I told you in the beginning, to teach your young adults, to teach your children about credit, because this is an amazing gift that you can give to them. Now, the thing that you have to understand is that everyone needs at least 2 credit cards. Otherwise, you're invisible to the Fico world. Okay, they are not picking up on the right algorithms, and you can't break the 750 barrier unless you have at least 2 credit cards. Okay, and again, you know, don't open credit cards when you're in the middle of a loan process. And we talked about revolving credit cards and why those are super important. Now, the thing to remember also is when you open new credit cards, it's going to take at least 6 months to build up the algorithms where you're going to have a positive credit score and an experience with the next bank. We're going to skip that one. We're going to skip this one too. The last thing I want to talk about is kids and credit. Again, you can see how passionate I am about teaching the younger generation. And let me tell you why. If we don't teach this younger generation, they are going to ruin our credit system. And I say ruin with a capital R. Okay, it is a very amazing system. Again, it helps us leverage our cash position by having a really good credit score. So work with your kids now. If you have a 16-year-old, help them by getting them as an authorized user onto your credit card. What does that do? The history that you've built over the years of your credit is now going to show up on your teen's credit history. And it's going to look as though they've had credit history for a long time, and it's going to build algorithms. The other thing that you need to do is get them a custodial credit card. Okay, custodial meaning that you have the rights, you get all the emails, you get all the statements, you know what's going on, but they can actually use the credit card and get acclimated to the system. Don't send your kids out there in the world to go to college and then there are 100 different credit card companies out there saying, hey, get a free t-shirt and we'll give you $10,000. And what's the first thing that they do? Drinks on me, everyone. And then what's happening? They're paying that $10,000 off over 30 years. We want to teach our kids now. So what do? We solve problems and we have the answers as far as what Conquer Credit does. And I pride myself in that. So now if you guys have questions, now is the time to ask.
Wow, that was a lot of information.
I hope I didn't go too fast.
No. So when you said that if you pay off say like a car loan, it reduces your credit score because now that Jenga block just came out?
Yes. So when you have a car and the lease is expired, let's say, you've been building that credit over, the 2 to 5 years that you've been leasing. Now you have a new lease. So it's just changing algorithms. So you have an account that was open that's now closed and it's being deducted from what's been being built all that time that you've been using that particular account. So it's temporary, okay? It's not going to stay that way. It's very temporary.
How temporary? I mean,
it's 60 to 90 days.
That's temporary, okay.
Yeah.
Okay. Well, I think that's unfair. That's unfair.
I know it is, but it's the system, and that's why we have to make plans.
Angela, what about a lot of our clients have payment plans with the IRS in different states across the country. Do those show up anywhere, payment plans? No.
No. The only time that will come up is when someone is purchasing a home and they do a public record search, then they're going to want to have proof of their payments.
I see, but it doesn't affect the credit score.
No, it does not.
And I'll second what Suzanne said. I think it's unfair because there's nowhere in all of this that your income is even questioned. Yeah. How much money you actually make. It's all about how you manage your spending. And so my ex-husband used to have fabulous credit. He was unemployed. And yeah. But I had terrible credit because all the debt was on my name. And it used to just drive me crazy because there's nothing that factors in how much money you make.
No, there is no stated income on a credit report. Absolutely. So that's why I said revolving credit is so important because it has an indicator of how you leverage your cash position.
I have another question. So if they're looking at debt to income ratio in order to give you a score, okay?
Debt to credit ratio. So let's separate the two.
Okay, see, I was confused. I'm so sorry.
No, that's okay because there is a distinction that everyone needs to know. Debt to income ratio is something that a bank or a lending institution is actually going to look at and take into consideration. But when you're looking at your credit history, it's only your credit to debt ratio. My
credit to debt ratio. Okay. So now I forgot my question.
You were saying debt to income ratio.
Oh, okay.
Yeah.
Okay, I remember my question. So how much how much debt is good debt? No, how much debt is, what percentage of all that debt, okay, is a bad debt?
Well,
I mean, can you have 30% of it be considered, no, it's going to reduce your score really badly, or
No,
80%?
no.
I mean,
Yeah, 70-30 is a perfect ratio. So 70% available, 30% balance. From a credit perspective, that's a perfect ratio.
so 70-30. So then I have to add all my 52 credit cards and figure out how much outstanding credit I have and how much I've used.
That's correct. Mm-hmm.
I see.
But believe it or not, all of these systems do it for you now. So when you go online and you go to a different credit provider that you're going to pull your credit history through, it has the algorithm that does it for you.
Well, I'm in deep trouble because I do not pay interest and haven't paid interest in many, many years. Nor do I even look at my credit score.
Ah, well.
I fall under that bracket.
Well, today you are a new woman.
You have,
It's really this weird anomaly though, you know, because people are taught, pay your bills on time, don't open credit cards, you don't need cash only. And so I have a lot of very wealthy clients that their credit scores are horrible because they have not managed that system. This is fascinating. Thank you so much, Angela. Can you share with us where and how everybody can reach you if they have follow-up questions or concerns that they didn't want to share in front of everybody?
Absolutely. So our telephone number is 818-530-0200. And of course, our website is conquercredit.com. And if you have a question, you can send it to customerservice@conquercredit.com. And that is on our website too. So there's a place for questions, and it will send it directly to us.
Thank you so much. I've been to Angela's website. It is a huge resource, so don't be shy to go and poke around there. Thank you so much. Like Suzanne said, you kind of blown our minds with all this information.
I know, it's a
we
lot.
really appreciate your extremely valuable time today. This was information that as an accountant, you would think I know, but I don't. And there's really nowhere to learn. There's no class you can take on this. So we really appreciate you sharing your knowledge with us. Thank you very much.
It's my pleasure. Have a great day, everyone.